We're going to focus on one possible explanation, which is that it has to do with an increase in demand for liquidity, and in particular, dollar liquidity. So, it's not. I think of this as kind of a scramble for dollars rather than what people usually call as a flight to safety. So let me preface everything by saying, I mean, we're not the only ones to argue that this appreciation is coming from an increased demand for liquidity. There's a recent paper this year by Jiang, Krishnamurthy, and Lustig. There's a paper by Kekra and Linnell. I mean, what we're doing differently, though, is that those papers take the increase in demand for liquidity as an exogenous shock. Here we're going to endogenize it and microfound it. So in particular, we're going to locate this demand for liquidity in the financial intermediation sector. And we're going to look at the increase in the financial intermediation sector's demand for our holdings of liquid assets relative to their short-term funding as a key indicator of this liquidity, demand for liquidity. So, underlying our idea here is that globally, there's a lot of short-term funding to the financial sector, to banks around the world in dollars, and we're just taking that as given. I mean, my own view is that that's kind of a historical, it's a historical fact that arises, actually much like in the paper by Gopinath and Stein. It arises from a lot of trade was originally funded in dollars and still is. But anyway, we're taking that as given. And so the banking system or the financial system relies on a lot of short-term dollar funding. But when uncertainty increases, then banks are going to have to, or banks are going to respond by increasing their holdings of liquid dollar assets as a precaution. And so in the US, I mean, this could just take the form of holding more reserves, although in fact, banks also hold a lot of short-term US treasuries. And in banks in other countries around the world, this would take the form of holding, say, US treasuries as well. And then this increase in demand for these liquid dollar assets then in turn leads to the appreciation of the dollar. Let me just, for the rest of the talk, to keep things simple, instead of having to say financial intermediation sector over and over, we're going to call those banks, but I don't mean just banks. I mean, this is shadow banks, I guess, and other other financial intermediaries that have balance sheets that where they have short-term liabilities, and then these liquid assets, which as I just said, I mean, we think of as being in the U.S. reserves, but in the rest of the world maybe short-term treasury assets. But let's just call them reserves for simplicity. So the outline of what I'm going to do here is I'm going to present some evidence to motivate the theory. Then I'm going to present a model that microfounds this demand for liquidity. And then I'm going to show a little bit of evidence generated from the model that it can account for the data. So the empirical motivation, we're going to look at the behavior of the dollar-euro exchange rate from 2001 to 2018. And actually, those dates are really constrained by data availability. And we're going to start with just a conventional regression where monetary policy drives the exchange rate, so interest rates and inflation rates. But we're going to throw in here then this liquidity ratio, the ratio of liquid assets to short-term funding in dollars. Now, we're only measuring this from US banks. I mean, we haven't been able to get detailed data on from the rest of the world on either short-term funding in dollars or liquid assets in dollars. I mean, I think that if we had access to a secret room at the BIS. That data exists, but not many people can get that data. So, but the idea here is that whatever is driving the U.S. Choice of this, U.S. banks' choice of this liquidity ratio is going to be the same as driving banks in the rest of the world. So we're going to just use that as our proxy for the liquidity ratio. And here we're taking as our measure of liquid assets the U.S. banks' holdings of reserves and treasury assets. And then their short-term funding is going to be measured here by demand deposits, plus this financial commercial paper, which is a variable that was in the paper by Adrian Etu and Shen. And so at the bottom here you see the simple regression that we start with. The exchange rate here is the euro per dollar exchange rate. And so you would expect that if banks are demanding more liquidity, that's going to appreciate the dollar. You would expect that beta 1 coefficient to be positive. This is the euro interest rate, the LIBOR rate relative to the US dollar LIBOR rate. So that should be a negative. And here, it turns out in a lot of these regressions that this is year-on-year inflation, and it turns out to actually be, I think, a good measure of monetary policy stance. So when European inflation is higher, that kind of indicates tighter ECB policy, and so that would also then generate a negative coefficient here, an appreciation of the euro. And in fact, then you know, here's that simple regression, and you know, the inflation variables and the interest rate variables come in with the signs that you would expect. But importantly for us, here's the liquidity ratio. So that also is highly significant. Just to be clear, we're talking about you know, these are not forecasting equations. This is the change in the contemporaneous exchange rate. We're explaining it with contemporaneous variables. And indeed, the liquidity ratio, you know, comes in very strongly. These are T statistics in parentheses. And it shows that when banks increase this liquidity ratio in dollars, the dollar tends to appreciate. Now, in the next table, we threw in the change in VIX, because part of my concern here is that, well, you would look at this and say, well, but you know, there's just uncertainty in the world, and indeed, this uncertainty about funding is what drives our model. But you might say, well, but this liquidity ratio is just picking up uncertainty. There are lots of explanations about why uncertainty could affect the value of the dollar. In fact, this paper by Lilly, Maggiore, Nyman, and Schrager found that the change in VIX was highly correlated with exchange rates over many, you know, subsamples at this period. So we threw in the change in VIX, and indeed it is highly significant. An increase in VIX will appreciate the dollar, but notice that it doesn't really affect the other variables. And in particular, it doesn't affect the significance of the liquidity ratio variable. So this liquidity ratio variable is picking up some other dimension of uncertainty. So maybe both of these variables are kind of capturing what we want, but the point here is that the liquidity ratio has some additional information that helps track the exchange rate. And then, and finally, in the next slide, we add in this other variable that that should say from Du, M, and Schrager, which is the U.S. Treasury basis, or the deviation from covered interest parity for U.S. Treasuries, are uniting to the U.S. Treasury interest rate minus the German interest rate, but where the German payments are converted into dollars through the forward market. And so this is supposed to measure the liquidity yield, or the convenience yield of the US Treasuries relative to German Treasuries. This is a variable that Jiang et al. Used in their paper and in my paper with Steve Wu, and it has a strong explanatory power for exchange rates. And indeed, you can see it coming in here. And in our paper, this variable ought to have strong explanatory power as well. In a sense, this is in a sense, what we're focusing on is the convenience yield on these highly liquid assets like U.S. Treasury bonds. And so that, but notice that all that doing this does here is it adds to the explanatory power for the exchange rate. It doesn't diminish the explanatory power for the liquidity ratio. So in a sense, all three of these variables, the liquidity ratio, the VIX, and the relative convenience yield are working in the way that our model is going to suggest, which is that uncertainty is driving up financial institutions' holdings of liquid assets relative to their funding, and that is increasing the demand for dollars. Now, let me just make 2 points before I get on to our model. I mean, one is that, this is not a exogenous variable here, the liquidity ratio. I mean, it's not exogenous in the world economy, and it's not exogenous in our model. So we're not saying that somehow exogenous changes in that drive the exchange rate. It's an endogenous variable in our model, and then we'll show what drives it. But then we're going to show that in the data generated from the model, we can replicate these regressions I just saw. We just saw. And the other thing I want to say about this regression is that although people are finding more success in accounting for exchange rate movements in recent years, almost all the regressions, maybe all the regressions I've seen, all the empirical work is really, prices explaining prices. The price being explained is the exchange rate, and then it's either goods prices or often financial prices that are explaining exchange rates. But here, this liquidity ratio is not a price. It's a quantity variable. It's a balance sheet variable. Indeed, no exchange rate went into the construction of that variable. And so it's especially interesting that it's significant in accounting for the euro-dollar exchange rate changes. All right, let me turn to the model. So this model is based on the Bianchi and Biggio closed economy model. And here's the basic facts about our model. It's a two-country model. We think of Europe as home, which ought to feel nice for most of the people at this conference, and the US is foreign. It's a general equilibrium model, stochastic, infinite horizon, discrete time. There's a single good. So the law of one price holds, prices are flexible. So in the current version of the model, the real exchange rate is constant. We're not going to actually have, be able to explain real exchange rate movements in the current version. It's just nominal exchange rate movements we're going after. There are households and firms in this model. They're going to kind of be in the background, especially in my talk, because they've been sort of set up in a way to be simplified and put the focus on the banks. But the households consume this single good. They supply labor, and they have saving in both currencies. And firms produce using labor, and they need loans because they have a working capital requirement that requires loans. But as I was indicating, I mean, the preferences, the technology, and the environment are in a sense all rigged up to make this real side of the economy simplified. And I can kind of summarize everything with basically static demand curves for deposits by the households and static, I should say static supply curves for deposits for the households and static demand curves for loans from the firm. So the action is all coming from the banks, and there'll be a continuum of banks, but we think of these as global banks. So we're not going to have a bank located in Europe and a bank located in the US. These are global banks, and their assets are going to be their loans to the firms, as well as the liquid assets, the euro reserves, or treasuries, and euro reserves or dollar reserves, and those can be treasuries as well. And the liabilities then are going to be these deposits by the households in euros or dollars. And then there's going to be a vector of aggregate shocks, but I'm going to focus today mostly on the shocks of the volatility withdrawals, but also on interest paid on these on reserves, which are the liquid asset. So let me make a few preliminary comments here before I do the model. So this draft is preliminary. The comments and suggestions are welcome. I want to emphasize that this is not a banking model of this Kiyotaki-Moore balance sheet constraint. So it's not like a Gertler, Karate, or Gabex Maggiore. I mean, you could put it in, and Bianchi Biggio have such a constraint in their model as well. But here, nothing's coming from that. It's going to come from this demand from liquidity. And also, households are risk neutral in our model. So there are no risk premium. I mean, you could put them in, but everything, that's not here. So everything, any deviations from uncovered interest parity are coming from this convenience yield. So what's going on? I mean, in words, the banks hold these liquid assets in case of unexpected withdrawals. If they run out of liquid assets, then they have to undertake costly borrowing, either in an interbank market, or what's even more expensive is if they can't get the funds they need on the interbank market, they have to go to the central bank discount window. So an increase in the volatility of dollar withdrawals or deposits leads to banks holding a higher liquid asset to deposit ratio for dollars. That in turn implies a higher liquidity yield or convenience yield on liquid dollar assets and an appreciation of the dollar. Okay, so let's just get into some equations and stuff. So for the banks, each period, and there's going to be an investment stage and a balancing stage. So this idea of liquidity is that there's going to be shocks that occur in the balancing stage, and that's when you need the liquid assets. So in the investment stage, the banks have some loans that they make to firms, and then they have their liquid assets, the foreign reserves, and the home reserves. So here, remember, the foreign country is the US. And on the liability side are the deposits, and then each period they've also, they can pay dividends, and they have some net worth. And so here's their constraint at time t. I've written everything here in real terms. The bank's decisions are all in real terms because they want to maximize the real value of the firm. But in the background, nominal variables are determined, and we'll see that in a minute. And then I've left off here the equation of motion for the state variable, the net worth. It's kind of complicated, and it wouldn't mean anything anyway until I present the rest of the model. Okay, so then what's going on in the balancing stage is that, okay, so firms have made their loans and they've gotten their deposits, and that was all done in the investment stage. And now there's a shock, and the households and some will withdraw deposits from some banks, and then they're going to deposit them in other banks. So there's not going to be any here. I'm not describing an aggregate change in deposits. It's just a reshuffling of deposits. And here's the home country, here's the foreign country. What am I referring to here? Well, S is the bank's surplus of reserves after this shock occurs. So here I'm pointing at the home country. M is the home country's holding of reserves. M is the bank's holding of home country reserves, of euro reserves. D was their euro deposits. And omega is the shock to bank J's deposits, which could be positive or negative. And so then S is what they have left over from their holding of reserves after they pay off the depositors. And likewise for their holdings of dollar reserves. And notice, by the way, I didn't put any J subscripts on the reserves or deposits because all the banks in the model are identical. Okay, and then a key thing in the model is this measure of tightness of the the interbank market, because you know what happens here is if you run out of reserves, if you end up with a shortfall, then you've got to go on this interbank market and borrow, and that's where it becomes costly to run out of reserves. So theta here is measuring the shortfall, or it's a measure of how tight the market is. So if there's a lot of firms that are out looking for reserves, then the market is going to be tight. So capital S is the aggregate shortfall. Capital S minus is the aggregate shortfall for the banks that ran out of reserves. Capital S plus is the aggregate surplus for the banks that still have reserves left over after these deposit shocks. And notice, by the way, I mean, to give you a sense of what's going on, theta's got to be a number less than 1, because you know, there's no aggregate loss of reserves here, and there's this precautionary motive to be holding reserves. So the guys, the amount of, you know, the guys that run out of reserves are going to not, the amount there's going to be enough reserves to satisfy them out there among the ones who have end up with a surplus. But so these guys, these banks, the ones that have the shortfall and the ones that have a surplus, they go into the interbank market and they search for a match, and there's a sort of iterative search process that goes on, but they're not all going to find a match. That is, not all the ones with the shortfall are going to find a match. And so a fraction psi minus are the ones that are going to find a match. I shouldn't say that. I'm saying it not quite right. They're not going to be able to borrow on the interbank market to cover all of their shortfall. So they're going to keep matching with people, but in the end, they're not going to be able to cover all their shortfall. And so the rest they have to borrow from the central bank. So they can borrow some from other banks at the interbank rate, but then if they don't cover all of their shortfall, they're going to have to borrow from the central bank at an even higher interest rate than the interbank rate. And then banks with a surplus, they're going to be able to lend some of their surplus, but they may not match and be able to lend all of it. So they're going to lend a fraction psi plus of their surplus, and the rest they're just not going to be able to lend, and they'll just earn the interest on reserves. But if they can lend on the interbank market, they're going to earn an interest rate higher than what they earn on the reserves. So to make that clear, chi minus is the rate of return relative to the return on reserves if you have a shortfall. So if you have a shortfall, then you're going to have to borrow, and the real interest on the interbank market is RF, and that's going to be higher than the interest rate on reserves. But even worse is if you don't match, and then you have to borrow at the discount window, and so this would be the cost of running out of reserves. And this is the gain for having a surplus. So if you have a surplus, you're going to be able to lend a fraction psi plus of it, and you're going to get the interbank rate. So this is the gain relative to the interest on reserves. So the R's are expected real rates of return. I is the nominal rate of return. And then the bank's problem, which I'm not going to write down in equations in these slides, is just to maximize the value of the firm, which is the expected present discounted value of the dividends they pay. As I said, the real economy is simplified. We're just going to have households that are going to have a demand for deposits in euros and in dollars. And then there's going to be this, I should say that's a supply of deposits from the households. And then there's going to be this demand for working capital loans from the firms. The central bank, what's the central bank doing? Well, they're setting the nominal money supply. So that's now we've got nominal stuff coming into the model. They're setting the nominal money supply. They're also setting the interest rate on reserves, as well as the interest rate at the discount window. W here is the amount they end up lending at the discount window, and then T is the transfers, lump sum transfers that make all of this balance out. So the equilibrium, the first order conditions for the banks hold, the real economy supply of deposits and demand for loans are satisfied, and the supply of deposits equal the demand for deposits, the demand for reserves equals supply of reserves, the law of one price holds, and then these market tightness variable is consistent with the portfolios and the distribution of withdrawals, and the matching probabilities or the matching fractions and the interbank rate are consistent with that market tightness. All right, now here's this convenience yield or returns in equilibrium, and so let's just look at the expected return from holding one more unit of reserves in the home currency, that's euros. And so what do we have here? Well, this, I'm getting my Greek letters confused. I guess this is phi. So phi is the probability that you have a shortfall, that a bank has a shortfall, and that depends on this the aggregate liquidity ratio. And then chi minus was the return you get if you have a shortfall, or the cost of having a shortfall. And then 1 minus phi is the probability of having a surplus, and chi plus was the return if you have a surplus. So if you get, if you have one more unit of reserves, the expected gain is the probability of having a surplus times the gain if you have a surplus, plus the probability of having a shortfall. You're going to avoid the cost of having a shortfall. And that's for euros. This is for dollars. It's just analogous. And then in equilibrium, the banks equate the expected returns on all of their assets, on the loans and on the reserves. But the key thing is, for the reserves, there's not just the monetary return like there is on the loans, but there's also this this liquidity yield from which was, on the last slide, from holding those reserves, the expected value of those reserves when you have to go to the interbank market. And so then we can use these two equations to write the deviation from uncovered interest parity. But in the deviation from uncovered interest parity arises here solely from this dollar liquidity premium, the expected liquidity value of holding dollars relative to the liquidity value of holding euros. And here, I've written out the left-hand side just to make clear that this is where the exchange rate is popping in, because the real returns are just deflated by the inflation rate, but the real returns on the dollars are converted into euros using the exchange rate. Okay, so let me just mention a couple of results and then get to what I think is the main result. So temporary increase in the supply of dollar deposits will increase this dollar liquidity premium. That's because an unexpected increase in dollar deposits means that banks are more likely to have a shortfall of reserves. If they have a shortfall of reserves, that's going to increase the liquidity value of having reserves. So this it's going to increase this convenience yield, or this dollar liquidity premium. Now, if there was an increase in the interest rate paid on dollar reserves, that lowers the dollar liquidity premium. So why is that? Well, a higher interest on dollar reserves makes those dollar reserves more attractive, so banks hold more of those in real terms. But if you hold more of them, that lowers the marginal value of having those dollar reserves. Now notice, by the way, that this goes in the direction of the Fama puzzle, that the higher US interest rate does imply lower ex-ante returns on the I think this, I've got this backwards because I started thinking like an American, but I think this means lower ex-ante returns on the Euro bonds. And one other thing I want to mention here is that, an interesting part of this is that really because there's this wedge between the interest paid on reserves and the interbank rate, the central bank, it's like it has two different policy instruments. So in our model, it's the money supply and the interest on reserves. But maybe in the real world, you could think of the two instruments as being kind of the market interest rate that they, I mean, in these days in the real world, it would be like the market interest rate they control, like the interbank rate or the Fed funds rate, and interest rate on reserves. So that wedge is acting like a separate instrument, and that's the key thing that we're focusing on and driving the dollar here.
Yeah, 5 minutes.
5 minutes, yeah. Good. Okay, so then finally, the main result I wanted to talk about was this greater volatility. So think of a case where the fraction of deposits that are withdrawn or added to a bank is a random variable that can take on a positive value of delta or a negative value, value delta or minus delta with equal probability. So an increase in delta is an increase in the volatility of deposits without changing the mean level of deposits. So what happens here? Well, again, I've said the intuition a dozen times now, but this will lead banks to increase their ratio of reserves to deposits. There's this increase in the dollar liquidity premium because now, because of this uncertainty, banks value liquid assets at the margin, and this is going to lead to an appreciation of the dollar. It's like an increase in an unobserved return on these liquid assets. So as the volatility of the deposits rise, the value of liquidity rises, and banks acquire more reserves in dollars, and the dollar appreciates. So I don't have time to go through this in detail, but I just want to show you how, what comes out of simulations of the model. There are a bunch of parameters that need to be calibrated. There's some targeted moments and non-targeted moments. I don't have time for that, but let me just show you. This is what happens here. We're going to, along the horizontal axis in all these graphs are the volatility of deposits. And here you can see that as the volatility of dollar deposits rises, this liquidity ratio for the in dollars rises. And then you can also see as the volatility increases, the exchange rate is higher. This is the euro per dollar exchange rate, so that's an appreciation of the dollar. Bunch of other stuff I can point to, but I just want to go along the bottom row for a second because, these are the deviations from uncovered interest parity. And actually, there are a lot of deviations from uncovered interest parity in this model, depending on what interest rate you want to look at. So in this previous slides, I had the expression for the deviation from uncovered interest parity on using reserves as the interest rate, and as the volatility goes up, that rises. But you could look at the deviation using interest paid on deposits as the interest rate, or the interbank rate, and they all show the same picture that as this volatility increases, the deviations increase. And finally, I want to show you these regressions that are generated from the model, and we look at two different shocks here. So the first shock looks at this increase in volatility deposits, holding the interest paid on reserves constant. And here we see the positive coefficient that we saw in the data that increases in the dollar liquidity ratio will appreciate the dollar. Here, as you increase the interest paid on dollar reserves, that's going to work the way our regressions say. Remember the regressions, the interest rate had a negative sign, but the liquidity ratio had a positive sign. Here we put them both together. And, as in the regressions reported 1, you've got this positive shock on the liquidity ratio, meaning there's this positive correlation between the liquidity ratio and the value of the dollar. And that's, as I say, it was at the start, I said it's an endogenous variable, but we replicate this, what we saw in the data here. So let me just conclude, my time's up. So, you know, I think many papers recently have looked at convenience yields or liquidity yields, but not really with strong micro foundations. So we're locating the source of the convenience yield and the value of liquidity to financial institutions. And our model draws a link between these observed liquidity ratios and the value of the dollar. So we find that empirically, and as I mentioned, I mean, it's nice that we've got a connection between exchange rates and something that's not just another price, it's a balance sheet quantity. And finally, you know, we've got a lot of things left to do with this model, and we're talking all the time, and also with the data, we want to do more. So, you know, your comments are certainly welcome.